Of course, we've got the dollar rand at risk of pushing 705 this morning. That was the statement given the global markets caution in front of today's U.S. non-farm payrolls number. Your expectations ahead of that report hitting the markets?
Good morning, Alishia. Yes, we've seen quite a bit of risk appetite creeping back into the market for most of the week. But last night, that risk appetite started to wane again, and we saw some of the risky assets coming off, and that's what caused kind of dollar rand to bounce from that 696 level. And as you say, we back up above the 7 rand handle, and at this stage, it looks like the bias is in favour of extended rand weakness into the payrolls number. I think the market is very nervous that this number could also disappoint and then once again bring about those concerns about the state of this global recovery.
Yeah, there's consensus for 75,000 jobs to have been created in July, but there's an unusual disparity in those forecasts that are out there, Michael. I mean, where do your forecasts lie?
Yeah, look, we don't take a specific view on payrolls forecast, so we would take our guidance from where the actual number comes out relative to the consensus. And I think the bottom line is here, we've got to start seeing a sustained improvement in the payrolls figures. And that I think is going to take a couple of months to materialise, even if today's number actually impresses. So I don't think we're out of the woods yet, and that's why I think the bias is in favour of more risk aversion, because I don't think these numbers are going to soothe those global growth concerns. I think we've seen it in a number of indices already this week. If you look at some of the manufacturing data we saw out of Europe yesterday, we're by no means out of the woods, and as a result, I think these global growth concerns are going to continue to weigh on international sentiment, and that's even if we see the market pricing in an increased probability of more Fed accommodation. I think in the past 2 years we've seen risky assets, commodities doing very well due to all this global liquidity being injected into the financial markets. But I think this time around, even those kind of die-hard speculators out there are becoming increasingly concerned that there's just no underlying economic activity coming through. And of course, the volatility in the markets is also killing those risky trade positions. So I don't even think that risky assets will do well, even if it raises the probability of another round of monetary stimulus from the Fed.
Of course, important probably to put in the status then of the rand as a risky asset in this context, because yes, we've seen some strength filtered through. We've seen that move below the 7 handle, but a lot of that having to do with dollar weakness, because if you're looking at the rand against a basket of trading partner currencies, we're not looking as strong, and especially if you're looking at it on a month basis.
Absolutely, Alishia. I mean, this is something that we've been driving home for most of this year, is that actually the rand has been one of the worst performing currencies year to date. It's weakened against just about everybody, the noticeable exception being the Turkish lira, another sort of high risk emerging market currency. But, the rand hasn't been strong at all this year. If you look at the crosses, it has very much been a weaker dollar story that's sort of artificially created this perception that the rand has been strong. And I think now that the dollar is recovering, because people are sort of seeking safety of treasuries and gold, and the dollar is recovering, that's when the rand's weakness becomes a little bit more exposed. But it has been weak, and as you say, over the past month, it remains weak across the board.
And at this stage, we've got risks weighing pretty evenly when it comes to the euro and the dollar as well. On the currency front, in that, what are you thinking when it comes to the euro and the dollar, and who's the lesser of the ugly sister at this stage?
Look, in the medium term, we still favour the 120 move in euro dollar. We think that the dollar will benefit, as I say, from this safe haven purchasing of treasuries and bonds. I think the one worry that we also have about Europe is the potential liquidity crisis that could come through. And if that starts to come through as a result of the sovereign debt crisis, then I think Europe is really going to come under pressure. I think the euro has been remarkably resilient this year, given all these sovereign debt concerns. And I think if we look at the States, they probably have been a bit more proactive. The ECB has probably now kicking itself for hiking rates early in the year. So I think the Fed once again is probably ahead of the curve, but we have to ride the storm out. And I think between the two, I still favour the dollar in the short term. In the longer term, I think the dollar is vulnerable to inflation differentials, and I think also the diversification of reserves out of dollars and into things like euros, commodities, etc.